Hello, and welcome to Arnerich Massena's fourth quarter MarketCast. I really hope you found some time to rest and relax over the holiday season. Looking back on the events of the past year, I don't think anybody could have anticipated the kind of year we had in store for us. It felt like a year of constant challenge for us as a society and as investors. And while I think our country faces many more tough challenges ahead, I view this as an opportunity for all of us to step up and make a positive real-world impact in whatever way we can. Now, looking at the past year through an investment lens, I'm really pleased to see that many of our investment ideas have started to come to fruition. So let's settle in and look at what's been happening in the markets and what the outlook is going forward. As you may recall, in November, the world's stock markets took off on the news of several vaccine breakthroughs and the idea of the economy reopening. In the fourth quarter, emerging markets and international stocks led the way with returns in the high teens, followed by U.S. stocks and high-yield bonds. And global bonds also advanced on currency gains, while the U.S. investment-grade bonds and Treasury bills remained nearly flat. Looking back over the last full year, it was a great year for investing. All of the major asset classes closed the year in positive territory. But the fourth quarter wasn't just about the stock market going up. We think a potentially even more interesting story was about rotation, or a change in market leadership. As confidence rose in the fourth quarter, investors shifted their attention to previously overlooked small cap and international stocks. Small cap stocks had their best quarter in history and outperformed large cap stocks by an astonishing 19%. And international stocks had their best quarter in over a decade and beat U.S. stocks by almost 5%. While this change in leadership doesn't necessarily mean that we're at the beginning of a long-term trend, history has shown that changes in market leadership, once established, can often last for years. However, with results this good, is it possible that stocks have been getting a little expensive? Here we see that stock price-to-earnings ratios have been rising to levels we haven't seen in a long time. So we have some concern that in 2020, the market was just effectively borrowing forward future returns that will have to be paid back through lower returns going forward. On the other hand, if we look at stock dividends, we see dividend yields are now higher than the yield on the 10-year U.S. Treasury note. So in terms of generating cash for investors, stocks look more attractive relative to bonds than they have been in the past. And this could actually wind up attracting even more money into stocks, driving prices up even further. The bottom line is we have a peculiar situation where the pandemic and monetary policy have been pushing two major buy-sell indicators really in opposite directions. In a situation like this, we think it's best to not let any one single indicator dominate our thinking. But bear in mind, falling bond yields are nothing new. Bond yields have been declining since 1981 and are now at near all-time lows. For investors, it's important to keep in mind that yield has historically been a really good predictor of future bond returns, as you can see in the chart. Also, given that the Fed expects to remain aggressive in keeping rates low, we think it's likely that bonds will be disappointing over the next few years. So the big question today is, with stocks possibly looking expensive and traditional bonds likely to disappoint, where should investors be looking? Fortunately, we think the next few years can be a conducive environment for alternative investments. Because historically, alternative investments have tended to perform very well during months when bond returns have been low and range-bound. This chart shows the long-term historical annualized returns and volatility of alternative investment indexes during months when bonds have returned between negative 1% and positive 1%. As you can see, that many of the alternative strategies have added value in this kind of environment. So we think that if bond returns remain stagnant over the next few years, as we think they will, then alternative investments should not only outperform, but also add some diversification benefits as well. And just as diversification is good in portfolios, we think it's good to bring diversity into company management as well. In 2019, the Wall Street Journal reported that the 20 most diverse companies in the S&P 500 had better operating results on average than the lowest scoring firms, and that their stocks generally outperformed those of the least diverse firms. Yet female representation on boards overall remains low across the S&P 500 index. Less than 2% of companies have boards consisting of 50% or more women. So this suggests that there is an opportunity for investment firms to enhance their performance by integrating diversity and inclusion into their investment process. So now let's turn our attention to the events of 2020 and what they might mean for the future. If you could have somehow known all of last year's outrageous headlines ahead of time, would you have ever guessed the S&P 500 index would have returned 18.4% for the year? Last year's strong results demonstrate that stock prices look forward and don't necessarily reflect the daily quality of life. In fact, historically, the best market returns have often occurred when conditions were the most dire. So we think that trying to time the market is incredibly risky. If you missed out on the 5 best days since 1980, your portfolio would be 35% smaller today than just staying the course. Rather than trying to predict short-term events and how the market might react, we think it makes more sense to build a well-balanced portfolio that suits your long-term risk and return objectives. When we build well-balanced long-term portfolios, we use forward-looking estimates of asset class return and volatility. And this chart shows our market expectations for the next 10 years. We expect private equity, emerging markets, international equity, and private real estate to be among the best performers going forward. But due to low market yields, conservative investments such as cash and fixed income are likely to deliver very low returns. And as we mentioned earlier, we expect alternative hedge and diversifying investments to return more than bonds, but with less volatility than stocks. So what's our strategy going forward? I'd like to introduce Katherine Fox, Philanthropic and investment advisor and planner, who will share our latest thinking on portfolio positioning.
Thanks, Bryan. Now I'm going to talk about what these ideas mean for your portfolio. As Bryan mentioned, it looks like we're moving into an environment that will be difficult for traditional bond yields. As a result, we've been reducing portfolio bond allocations while increasing allocations to alternative hedge and diversifying investments. While we still hold traditional bonds for liquidity and rebalancing purposes, we're managing that risk by limiting duration and credit exposure. With our equities, the main driver of portfolio performance, we're holding steady. Last quarter, we discussed the U.S. market's increasing concentration in just a few companies, which we thought might signal a turning point in market leadership. Well, that is exactly what we've been seeing. As a result, we're continuing to emphasize smaller U.S. companies as well as international and emerging market companies, which we think are well positioned to benefit from a continued economic recovery. As always, we'll continue bringing you new investment ideas in the months to come. All advisors are working closely with our clients to discuss new opportunities as they become available. Finally, we are very excited to announce that Arnerich Massena will be honored as one of Real Leaders' top impact companies of 2021. This list recognizes those organizations that are global leaders in making a positive social and environmental impact and includes industry game changers Tesla, Beyond Meat, and Patagonia, among others. We're excited to be recognized among these visionary companies as a reflection of the top-tier impact investing research and expertise we've cultivated over the past 30 years. A special ceremony on January 27th will honor the winners. You can find more information on our website or on the Real Leaders website. Thanks again to everyone for joining us.